All right, live and direct coming to you straight from Facebook, YouTube, X, Instagram, wherever you're watching us today. Welcome. This is Ask Me Anything, the BYOB Money Mentor team. This is the place to be every Wednesday, 4:30 Eastern, to answer all your questions around infinite banking, real estate investing, private money lending, becoming your own banker, and any other wealth strategies that you might be curious about. We're here to answer those questions, share our experience, and see if we can guide you in the right direction. With all that being said, we have a smaller group today of mentors. A lot of our team are in Alabama at the Nelson Nash Institute think tank. So they are there learning and networking and growing. And we are here to help everyone on Ask Me Anything. So with that said, get your questions in the chat box. We'll answer those in just a moment. We will be right back after this short commercial break. All right. My name's Stephen Nagy. I'll be helping host the show today along with the real host, Brian Fouts, but we are here to answer your questions. Like I said, get them in the chat box. It's been a good day today. Oh, we got the real Bad Bunny in the house. What's up? Hola, mi amigo. ¿Cómo está? So we're going to answer your questions. We had a good day today. We started out with What the F, rolled right into Wealth Webinar, and here we are at AMA. So always a fun hump day, wins day, education. All right, so let's do a little around the horn here, and then we'll get to answer your questions. So there's Brian.
Hey everybody, Brian Fouts here up in North Idaho. Had fun on the Wealth Wednesday today. And it's kind of interesting. I was having a phone call here just a bit ago with someone. I think they're in Oregon, but we were talking about how this is the craziest winter that people have had here in decades. I was outside in flip-flops and a t-shirt loading my truck up. And last year, I think this time of year, we were in Sundance, I think this time last year, the BYOB team. And my pipes froze and burst under the house the same time last year because it was negative 15 degrees. And here it's like 40-some degrees today. It's just nuts. So I don't think I'm going to have a winter this year. But, Joe, you can have all my snow, by the way.
No, I don't want any more. I mean, yesterday I think it was 10 degrees. So we got the cold and the snow. So you take it back.
No, I'm good. I'm going to keep it this way, though. But with that, I'll pass it down to Kevin.
All right. Thanks, Brian. Kevin Krause, upstate New York, not far from Mr. Joe Helock and the rest of the team. It's actually been a heat wave today. It's like 33 degrees, so some of that snow is kind of melting, but it did snow a little bit more. But yeah, like Joe said, it's been definitely in the negatives. I think a few days ago it was like negative 10 over the weekend, and then it's kind of slowly kind of been going up and down, warming up. But we're all ready to go. I'll be scooting out of here. My son's got basketball today, so I'll be heading out. But we're looking forward to answering all your questions, getting all those comments in there to help everybody with infinite banking and anything else that's going on. Down to Joe.
Hey, thanks, Kev. Yeah, we're about what, an hour or so away from each other.
Yeah, a couple hours, I'd say.
And the way that the wind is coming off the lake, it's kind of hitting me, but it's hitting you too. So I'm glad that we could share.
Yep.
So.
Well, now that we know about the weather across the country, answering some questions.
Start answering some questions. Let's do it.
Get those questions in there.
IBC, what are we going to do?
All right, let's start with the star himself, the star of the hour, the Super Bowl performance of a lifetime, Bad Bunny in the house. What's up, Benito? All right, can you talk about IBC with Emeritus? I hear they have super flexible PUA payment options. What are your thoughts?
Well, we don't really work with Emeritus just because, I mean,
well, I can answer this question. So we've looked into partnering and contracting with Emeritus to offer their products and services to our clients. for several reasons. They were not able to compete with the carriers that we currently use, as in One America, Lafayette Life, Security Mutual, as well as a couple others. Ameritas did not seem to have the illustration strength. The other companies we use actually have more flexible PUAs from what we saw.
Yeah.
And their dividends, which is probably why the illustration didn't look as great, didn't seem to be as strong. So I know that people use Ameritas. I believe it's just because that's who they happen to be contracted with for IUL. For IBC. We just, from what I've seen, have better options for our clients.
And I've looked at quite a few Ameritas policies.
What's that?
I've looked at quite a few Ameritas illustrations before, just from other clients, and I've either replicated them or built ones that are slightly more efficient than those ones. So just from personal experience, the handful that I've seen, I've been able to build ones that are very similar or even more cash value heavy, I guess I would say. But yeah, I mean, if you have your experience, let us know what your experience is.
Yeah, I mean, it's a good company from what I've heard, but we just don't have a reason to go with them. But what were you saying, Joe?
I built the one or two times that I looked at them, I built one that was more efficient. So
yeah,
just depends.
Very common theme there.
Cool.
All right, Damien says, will I see you at the event on the 27th? I am putting in my ticket next week. So I think you're talking about Tampa, the Money Game Live. I am figuring it out right now. I will be there. I don't know if I will be there for VIP and day one or day one and day two. So I'll be there, just not sure exactly when. But yeah, Tampa, Florida, moneygamelive.com. Hannah Kessler, Larry Steinhaus are hosting the event. There's a plethora of speakers and experts that will be there, including Les Brown, which is pretty cool. Les Brown's been around the industry a long time.
Yeah.
And so it should be a cool event. So if you're in the Tampa area, would love to see you. I know there's tickets still available.
Cool.
All right. Hello from Bradenton, Florida. Maybe how's the weather in Bradenton, since we're checking weather everywhere today? All right. Damon from Rhode Island. Yeah, you guys love the snow, that's for sure. Raining in San Diego. So maybe hell froze over and now it's raining in San Diego. What's going on out there? All right. Whose kid is selling Girl Scout cookies? I want to buy from my folks. Sounds good, Dex. I don't know. You guys participate in any of that?
I got some.
Yeah. I bought some from one of our friends. I don't have anyone.
Ariana does it.
You're a Girl Scout?
Ariana is. Actually, I am too, to be honest with you. So, I mean, I have the shirt, man enough to be a Girl Scout. So, yeah.
How do you buy from you then? Just send you a text?
I'll text her. I don't know if Ariana put in her form yet already or not. I'll
Gotcha.
find out.
All right, Dexter. Remember, limit yourself to 3 boxes per night. Okay.
Per night.
Sure, come up.
Mayor said, for the mentors here, not to be confused with the mentors there. He says, can someone achieve true financial freedom without understanding their deeper purpose or spiritual foundation? How important is faith in long-term wealth building? Wow, that's like a Saturday night drinking around the campfire.
Yeah,
talk right there. But let's
Yeah.
go. What do you guys say?
Faith, health, and wealth.
Yep.
Let's start.
When I was studying Bob Proctor and going through one of his advanced programs, I mean, they intertwine all of this stuff 100%. 100% they intertwine all that kind of stuff. Now, can you have it freedom without having the purpose and the spiritual? Yeah. But the way I was trained in that stuff, or I was mentored, was that's kind of like your shining light, your call it the lighthouse, the thing that's leading you towards that direction. If you don't have that, sometimes it's kind of hard to have a direction or a reason to go in a certain direction. So it creates purpose. I mean, purpose creates action.
Yep.
So
that's what I was going to say, reason and purpose.
And that changes, by the way. On your journey, that can change many times throughout your life. I mean, I've actually lost purpose and got it back and all that kind of stuff. And yeah, you definitely see an impact in the life around you.
A lot of people talk about faith, family, fitness, fun, freedom. It's kind of like a few F's or whatever. Obviously having that purpose is super important, right? But definitely, like Brian said, you can achieve it without those things. But those things are actually, I would say, probably, if not more important of a foundation. Once you reach that foundation, it gives you that more of a direction and more opportunities will fall and come in front of you. If you continue to help other people, obviously opportunities are going to just fall on your plate. So if you can continue that mindset, helping others, helping yourself, and just making the world a better place, then obviously that financial freedom will come.
Yeah.
I love it, man. I love it. It's a great question, though. It's something definitely to think about, and to me, write it out, start writing down what that looks like. I mean, because things change over time, and it's always interesting to go back and look at that. Where you started, kind of remind yourself of that. Stay founded, or stay grounded, I should say. Yeah. I mean, how important is faith in long-term wealth building? It's I think it's one of those things where if you have faith, a lot of times you have focus. You do have that purpose. You do have a reason to go out there and push. I mean, to create true wealth, in my opinion, you need to be well-rounded, right?
Yeah.
And,
when I was doing it, so I can't remember one of my mentors. He said, and they did this study, Bob Proctor did, and they said if you go around and you walk around and you ask people, "What's your purpose in life?" the percentage of who can answer that question with certainty is like, 1, 2, 3% maybe can answer that question with any form of certainty. That's kind of scary. So, but guess who those typical that 1 to 2% are? They're going to be more successful in most cases, or happier, all that kind of stuff. So, yeah, if you can answer that question, that's good. So, I mean, someone asked me that question, I have a statement that I literally, memorized. So,
very cool. All right, Roy 1669 said, do PUA add to the compounding of the cash value?
The PUA is the banking system of the policy. That is what gives you your dividends, and that is what we borrow.
Yeah. So the dividends are what compound, because dividends purchase PUAs. So the dividends are calculated on the prior deposits, so they grow every single year. That's the compounding. I always say the PUAs necessarily don't compound, but the dividends that purchase the PUAs creates the compounding. Because there are dividends in your policy that do not compound, or sorry, PUAs that don't compound. Your PUA in the premium doesn't compound because it's just a PUA. Your PUA in the dump-in doesn't really compound. The dividends, which purchase PUAs, they compound. So the three PUAs.
Yeah, the PUA is the banking portion that we borrow, and that number is what we make the dividends on.
Yep. Oh, and here's one of our Tess. She's actually at the event right now.
Hey, Tess.
Yep. Enjoy.
Very cool. All right, where are we at, Brian? Here we go. Hello, all. Hi, Guy Jenkins, 8554. If I overfund a policy with a dump in and you say change one thing about where you put your money, where do you put it if your premiums are paid from a dump in?
They're not.
A portion. So he's saying that if he dumps in 100,000 and 20,000 would be his premium, you still have $80,000 in your dump in. The dump in is part of the PUA.
Yeah.
That is.
The way I always
you don't fund it one time, so you don't just dump in the money and that's it. You know, there's no one time premium. There's no one single pay premium on these.
Sure.
It would mech the policy, and so you can't use it for banking. So when we talk about a dump in, it's a dump in year one, and then you continue to put money in annually. And so we'll do a strategy call with you to talk about what that right amount is, so you know how much you can put into that, where you are changing that one thing, where your money goes first. But it will take time to get all of your money, and some people will never get all of their money flowing to the policy. The idea is to get as much as possible through it.
Yeah.
So I think he's also talking about where do you put it, afterwards. Obviously, if you start a policy, right, you're going to have to continue to pay yourself, let's say, every month, right, whether it's putting into a savings account or whatever vehicle. So it's like getting ready to be put into a policy every single year. Or hey, if you're monthly, boom, then you're putting it in monthly, right? So it's just a different way to kind of look at it from the standpoint of once your policy started, how do you pay yourself first? Well, you obviously allocate for that, right? And try to set it up automatically so you don't even have to think about it. And it makes it very easy for you to set that money aside and make it happen for your deposit, your monthly or annual deposit from your banking system.
And the way I always explain it is that there's a primary way that you fund the policy and a secondary way. The primary way is the premium. So the premium is the foundation of the entire policy. So there is going to be a premium, whether monthly or annually, however you do that. Then you have the optional second way to fund the policy, which is a dump in. It's going to be one time or sometimes more than once. So just going to keep that in mind. Who's typing? Steven.
Machine gun typing.
Yeah. I think we already answered this question. Yeah, we already answered that one. Let's go do this one here. All right. Michael Justine says, I'm doing velocity banking with infinite banking, just starting. Awesome. The only debt I have is my all-in-one HELOC, which is $260K. I'm putting $2K a month towards infinite banking. Goal is to pay off the HELOC, but want to use private money club, ?
So your HELOC will be your nucleus. That is the operating account. All the money that comes into the house goes into the HELOC. As soon as the direct deposit hits that checking account at midnight, I would imagine you have a sweep account that automatically sweeps into the HELOC. So now during the month, I don't know, $2,000 a month. So on the 15th of the month, the insurance company comes into the checking account and grabs your $2,000, and that goes to your IBC. Well, after that comes to cash value, a couple days later or whatever, now that money comes back into the HELOC. Now you use the HELOC money and find something in PNC to invest in. What is that going to give you now? Cash flow. More cash flow that comes in on top of your weekly earnings. Now all of that still compiles inside of the HELOC as the operating account. Oh, it's the next month. Insurance company comes back in, grabs the $2,000, rinse and repeat. That would be your circle.
Yep. Cool. I love it. Gary God. Hi, guys. We've been watching your bank videos. How do I go about getting a deal with you or getting to deal with you? So we'll go ahead and put in the chat box here in a moment the call link so that you can grab a time to chat with one of our mentors. Where is that link? I always forget what the link is for this one. Steven, you know what it is, right? Yeah, we'll go and put that here in the chat box in a moment for you, Gary. Let's see here. Let's see. Damien, could you give an example of how the vault helps with investing? So I mean, I guess it depends, Damien, on the what you're looking to do with it. But with the vault, you can actually map out loans with the policy. So it's going to help you forecast the loans, the rates, all that kind of stuff.
Yeah. Hey, Brian, let me help real fast. So right now it doesn't, but soon, very soon, the gains projector will be built into the vault. And so you'll be able to project out what your investments look like using the policy with the vault. It's just the functionality is not live yet. They're in beta testing right now. It should be coming out in the next couple of weeks. And then at that point, it'll help you visualize it. I don't know if it'll help beyond that with investing, but if you are looking for investing out specifically real estate, Private Money Club offers a few different programs right now to really get into real estate, private lending, things of that nature. So it just kind of depends on what kind of help you're looking for and what you need, Damien. But when the gains projector goes live, though, you'll be able to use it to visualize that.
Yeah, it'll combine the loans and the investment together.
Yeah, so you get to see the policy grow, you get to see the investment grow, you get to see all your debt go away, right? So it'll be all encompassing. It's going to be sweet once he gets to add that in.
Yep. All right. The Fake Bunny says, I have a Guardian policy, still in the first year, paid additional PUAs beyond what was projected. Okay. Cash value went up, but not the death benefit. Is that normal this soon into a policy? No. If your cash value goes up via a PUA, your death benefit should go up. They're not, of course, the same number, but PUAs buy some additional death benefit, permanent death benefit. So it should go up. If it didn't, I'd be calling Guardian right now and asking them what's going on. You want to make sure there's not something going on that you're not aware of. But definitely, I would call Guardian. Yeah.
I'm curious if you even checked this, like if you got an annual statement, you had to even see that,
Well,
right?
keep this in mind too. When you depends on what you're looking at. When there's more than one type of death benefit in these policies. You've got your base death benefit, you've got potentially term or combo death benefit, and you've got PUA death benefit. Sometimes they'll show those numbers all separately in different parts of your portal when you log in. So you might not be looking at the PUA death benefit. You might be looking at base death benefit, and that will not change.
Mm-hmm.
But the PUA death benefit, which adds to the permanent one, will go up. So yeah, as Kevin said, maybe the annual statement will show that, but it should show it inside the portal. Mine does at least, but not Guardian, but it does show it. But that's interesting, yeah. So Damien, this is an interesting comment he made. He goes, I use my dividends as a recycled fund to buy my policies. So when you get dividends, are you taking them out to fund additional policies?
I'm hoping his dividends are being reinvested into cash value, and then he's going to use that cash value to help do his annual or monthly.
Yeah.
Or is he taking like a loan from a policy to fund his other policies? I mean, hopefully he's not. I don't know. It's a strategy, right? Whether it's the right one for you, that's a different.
Absolutely strategy.
Yep. So Amir K78 says, powerful. And this is referring to the comment I made about how many people know their purpose. If only 1% can clearly define their purpose in life, doesn't that mean that most people are chasing money without direction?
Absolutely.
I mean, yeah, trading time for money. So then how do we ensure our success aligns with something eternal? You just got to go through a process to find your purpose statement. Some people can naturally do it, but most people can't. And so there's a process that I go through that I've taught before that I learned from somebody else, but it's a multi-level process, and it involves like words and all these kind of things. But eventually you'll find what that purpose is, because most people, if you're not aware of it, it's subconscious, and subconsciously you don't know what it is potentially. So you've got to sort of dig for it. But in my opinion, you have to have someone teach you how to find it. It's not easy for most people.
Some people might even think like, hey, if I go buy this one thing, right, I'm going to be happy. Or, hey, if I make this much money, it's going to make me happy, right? So at some point, that's definitely not going to be the thing, right? You can't really, if internally you obviously want to be happy, but those things may not even make you happy. And I'd say most of the people that we're talking about in this 1 or 2%, those are obviously the people with the purpose and or have other things going on in their life that brings meaning that is probably more meaningful than the money. But then the money obviously is an additional thing, making you a better person. Some people who are bad people, they give them money and then they're a worse person, versus if you're a good person, you get more money and you do a lot of good things, right? So it's kind of finding that balance between, money and or your life and purpose, etc.
With the increase in money, that's more money that can be donated to, the church or to children functions or to better the community. So that's kind of where that would play out, I would think.
Yeah, that abundance versus scarcity idea, right?
Absolutely.
I hated my job at one point in time. So I chased money because I hated the job and ended up losing over $500,000. Chasing money. If I hadn't chased the money, I would have still had that money. But I was running away from something I didn't like, which is not a good thing, by the way. And so the more I chased money, the more, I don't want to say unhappy I was, but I just didn't enjoy it. And then once I stopped doing that and started chasing my purpose, which for me, by the way, is controlling time. Time to me is my most valuable asset. All of a sudden I made more money. It was freaky weird when that happened. I was like, okay, I'm not going to chase that. I'm going to chase the thing that I value the most, which is my purpose in time. Then the money came. So it's a weird thing. Yep. And someone said, yeah, money is the absolute magnifier of who we are, for sure. 100%. There you go.
I feel like you could almost relate that, Brian, to kind of like an IBC policy, right? Where you're kind of recycling. You're going out and doing positive things, and then you're paying yourself back, right? And you could be doing that whether helping your community, doing positive things in the environment, or anything in your life that you're trying to improve and help upon. Just Absolutely. Recycle, keep on doing it, just making that positive circle.
Yep, absolutely, 100%. All right, this is a good question from Shauna, a comment. So Shauna, she almost mech'd her policy, so paid her quarterly premium twice. Okay, that's interesting. Then they called me up and were going to send it back or apply it to a loan. She opted for loan payment, but glad I answered the phone. So Yeah, if you don't know what a MEC is, it's when a life insurance policy becomes taxable or a modified endowment contract, which we don't ever want to do those. We don't build those. And the insurance companies don't really want to do those either, really. So and the way you do a MEC or create a MEC is you put in too much cash value without the death benefit going up. That creates a MEC essentially. But the insurance companies will send the money back, or they'll call you. And if they can't get a hold of you, they'll call us. And so I've had lots of clients accidentally do the same thing, and then we'll get a phone call or an email from the insurance company saying, "Hey, what's going on here?" Because they will not just easily let that happen. And I think it's Guardian, by the way. I know this with Guardian. If you can actually log in and you can actually schedule an overpayment, and then they'll have a screen that pops up and says, "Do you want to do this? This will MEC the policy." Warning, warning, warning. And you got to click yes, okay.
Wow.
Yeah, so they'll make you say yes. And they not our policies, but some other some clients did that. They actually clicked yes and MEC the policies on with Guardian. And they're like, saying, "No, we didn't do it." And Guardian's like, we're talking to Guardian. And they're like, "We actually have a record of them actually clicking yes." So yeah, it's kind of interesting, but yeah, not easy to MEC a policy.
I wonder if maybe she didn't have it set up automatically, right? She manually clicks it every month. Is that kind of why I got paid twice?
Yeah, because most of the companies, they will only do the monthly ones automatically. Quarterly or annual you have to actually do it manually. You have to log in and pay it. Depends on the insurance company though. So yeah, so quarterly by the way, I have a client, hopefully you're not on the call right now. Every single quarter, we get a notification that their payment is late. We got to call them and remind them to do it. Every quarter. Same, yeah. So yeah, so you got to do it manually.
Got to put it in the calendar, right? In your phone or something, right? Ding, a week before it's due.
I wish they wouldn't do that. Yeah, the annual one is the big one because they don't do it for annually. So some people forget about it, and then the insurance company will call you. This is a good question. I don't know this one. So Dex is asking, my term rider ends soon. Would I need we need an exam again to keep my policy or keep it with the policy? So what he's referring to is we have these term riders in the policies that are typically for 7 years. They're based on a 10-year time frame, but that are usually 7 years. At year 8, they go away, or you can cancel the term rider. So Dex, I think you're asking is to keep it on the policy. You're asking if you can do an exam to keep it. So it depends on the insurance company, by the way. So you can renew it. But remember, when you renew term insurance, it renews typically for a year, like 1 year renewable, and it's expensive. It gets more expensive, but it should be in your illustration. It should show it.
Yeah, I was going to say if he keeps it on, that'll make the policy less efficient, I would think, if it's able to come off. If he wants to stuff in more, he could just add more to the PUA.
Yeah, it depends on what you're trying to do, because some people want to keep the higher death benefit because they have a need for death benefit. I mean, oftentimes you can just go get an outside term policy separate from your infinite banking one just to have more death benefit if you have a need for it for, a certain period of time.
If this policy is efficient, then his premium is going to drop also. And if his premium drops, now he can get another policy.
Yeah. Yeah, so I'm not sure on that one, what he's trying to do.
Yeah, I wasn't sure if he was talking about he wrote rider instead of like my term policy. So obviously, with a term policy is completely different than obviously like a whole life policy. But maybe that's why I was kind of a little bit confused. Like, hey, you got the exam early for the whole life policy, right? It should be for your whole entire life.
Yeah, no more exams.
Yep.
I believe, don't you even have to call up to tell them that you want the term rider to fall off?
Depends on the company. So One America, yes. Lafayette, no, is my understanding. Because Lafayette is truly a 7-year term, whereas One America is a 10-year term. You show it for 7, but they won't cancel it at year 8, from my understanding. You got to call them up. So, and this one's for you, Joe. I am still confused by what was just explained about the all-in-one HELOC.
So you're thinking that your HELOC is a debt. Your HELOC is actually, you can utilize it for an asset because you're using leverage and arbitrage. So when that money comes in, you're performing velocity banking on a monthly basis with your paycheck. If that paycheck is just sitting in the checking account doing absolutely nothing, your money is not working. So if you take that money on Friday, the 7th, and move it into that HELOC, well, until you need that money to pay the electric bill or gas bill, it's just sitting in the checking account purgatory, doing nothing. Move it into the HELOC, and now you're not paying interest on that money. The HELOC is the nucleus, that's the operating account. So why wouldn't you want to keep your money in that until you need it? The checking account does nothing for you, but the HELOC, if you put the money in there, now you're not paying interest on that money. It's actually going to work for that 15, 20 days until you need it.
Yeah.
I hope that helps a little bit.
Yeah, we kind of explained this a little bit in WWW today, the Wealth Wednesday webinar, because when you look at, like, think about interest, like we talk about how interest steals wealth. Well, there's a couple different ways to combat that. One, save interest or get rid of the interest. So what Joe's talking about is that, let's say you have, and this is an actual thing that happened to a client of mine. I didn't write their policy and didn't tell them to do this, but they had a cash value policy, life insurance with Lafayette, by the way, and they had $130,000 of cash value. Their advisor, who wrote the policy for them, told them to use it as an emergency fund and never pay the loans back. So this policy was 16 years old, and it had, very good policy. But they had been borrowing from it whenever they had an emergency and never paying the loans back. So now the loans were, I want to say it was like $70,000, $80,000, not paying the loans, not paying the interest. So what was happening? The interest was growing on this thing so fast that eventually it would lapse the policy. Come to find out, this client had $60,000 of cash sitting in their savings account doing nothing for them. And they'd had it there for years. So they're losing money because they're paying interest on that loan, but they're making nothing on the cash in the savings account, I found out. I just said, hey, what if you just parked the $60,000 on the policy loan? And all of a sudden they started thinking about that. They realized, wait a second, if I do that, then I'm not paying any interest on that loan. I'm going to save a bunch of money, about $9,000 a year is what it was, or something like that, or $8,000, whatever it was. And that's what they eventually did. And they saved the policy. So their mindset was, though, is that the cash they had, that gave them a certain level of certainty. It gave them certainty around money. But they're losing money over here. It's this weird thing. We do this all the time, by the way. People will have a massive amount of debt and a bunch of cash, but they're losing wealth. They're not gaining wealth. They're losing wealth because they're paying so much out the door every month to interest. If you just park the money somewhere else temporarily, all of a sudden you start to reverse that whole thing. So velocity banking is essentially taking the cash flow that you have, parking it somewhere temporarily so that you're not paying interest over here, which saves you money and it makes more money working for you. But it's a mindset thing. You really have to wrap your mind around it.
And if you have an IBC policy, why aren't you warehousing your wealth inside the policy? Why are you leaving it in Bank of America or Chase so that they can use your money? This is your credit union. Your policy is your bank, your credit union. Why don't you want to warehouse your money in that? You shouldn't have a savings account. That money should be in your policy. Same thing happened to me, Bri. You know how many people call me up and say, strategy session, and, oh yeah, I have a HELOC, but I only owe $20,000 on it. I'm like, okay, great. Do you have a savings account? Yeah. How much is in that? $30,000. Yeah. So let me get this straight. You got $30,000 in a savings account, making you less than 1%, and you're paying 7% in your HELOC. Well, that doesn't make too much sense. No, take the savings account, put it in the HELOC, and that money is still yours to use. I mean, people think, just like you said, savings need to be over here, debt needs to be over here. No, it's all, money is green. It belongs together.
And the fun thing about what you just said right there on that example of put the savings into the HELOC so that you're not paying interest, but mindset wise, I would still pay the HELOC payment. That's the way I would do it. There's still that loan there, really, essentially, but you're not paying interest on it. So I would still pay it back like I would if I hadn't parked the money there. That one, when people understand that concept right there, it's like, okay. It's really cool.
That's extra cash flow. So if you fill up the HELOC, now start filling up the policy.
There you go.
Warehouse your money inside of where it's beneficial for you.
Yep.
I definitely think that picture that you guys have is always really, really good, right? With the house, kind of showing the investments, showing the money coming in and out. I could do it right here with this, but All right. I gotta. All right, guys. We'll see you next time. I gotta.
All right, later, man.
All right, Kev.
Yeah.
This one's interesting. Victoria says, I literally looked up how to become my own bank in YouTube search and watched our video and my search and made it all the way here. That's awesome. So I love that. Yeah, that's how people find us. For
Awesome.
sure. Yeah. All right. So Dexter, so this is a question on the term thing he was talking about. When term policy comes off, premium drops a lot. It can, it depends on the age and size of policy. So does that give me option to dump more cash into current policy? I'll be too old for a new policy. Well, you're not too old for a new one, but no. So the when the term, let's say your premium for everybody watching is $1,000 per month. Let's say that the term amount is $200 or $300 of the $1,000. Just simple math here. At year 8, that $300 drops off for your premium, goes from $1,000 down to like $700. What Dex is asking here is, well, can I still put in $1,000? That $300 that was going to the term, can it go to like PUAs, cash value? Usually no. So yeah, usually no, it can't. It just depends on the insurance company. There may be some room to put in additional PUAs, but we wouldn't know until we call the insurance company and ask them. But the simple answer is, unfortunately, no, you can't put more in. But some people will drop off the term and then go do another policy.
So in that case, take that 300 that's not going to the term and put that back into paying the loan.
Mm-hmm.
At least it's still there for when you're using it, and that money will be going down.
Yep.
Keep it working for you.
Yeah. So this is just Brent kind of explaining a little bit more about the HELOC. Whatever you don't pay in the HELOC, yeah, all your equity should be or could be out earning interest in PMC. Yeah. So what he's talking about is that, you really never pay off the HELOC if you are putting that money to work in other assets. Now, granted, that's not for everybody. You have to understand, risks and rewards and what you're putting your money into, because that is investing. But yeah, so some people, like, their HELOC will never be paid off, like Joe, because that's always being put into asset. Yeah, it's always leveraged because it's creating cash flow. So some people get so focused on paying off a mortgage, paying off a debt, they don't realize, well, if I have a HELOC, it's actually can be a tool to create more wealth and more cash flow.
You got it.
So
it's a different way to use the tool. That's all. It's a tool. So if I use that and all that money comes in per month, as soon as I get another 50,000 or 100,000, what can I do? I can put that down on another dwelling, on another rental. Now that's cash flow, because now I'm going to rent it out. That money comes back into the HELOC again until I acquire another 50, another 100. Throw that out. Why would I ever want to just leave money in a HELOC and not put it to work? I'm utilizing it to build the whole, atmosphere, the whole system.
Yep. Yeah, Shauna has another example here. Put it in a bank does nothing for you, but grows the bank's credit line with their world. Yeah, so it's kind of an interesting thing. So like when you put your money into a bank, banks create something. It's anybody want to guess what I'm talking about? They cause something to happen. It's the second cause of this too, by the way. It's inflation. So banks are the second leading cause of inflation because they can leverage your money 10 to 1 or 9 to 1, meaning they can lend out 9 times what you give them. Where does that money come from? Basically out of thin air, by the way. So they create money out of thin air through loans, which creates more money in supply, which waters down the whole dollar, which means it's inflation, causing inflation. So yeah, banks are dangerous, by the way, in my opinion. They're really dangerous. It's kind of interesting. We didn't talk about this today, but we talked about it before. But if you think about how inflation happens, the Federal Reserve prints money. How long does that take for it to get down to the people, which are the banks? Some people say 1 year, some people say 3 years. It takes a while for that money to flow into the system. Then the banks turn around and lend it out 10 times. More inflation, more money. So it's a very disastrous cycle. And that's what she's referring to. Just crazy what they do. See here. Hey, new mentors. Will I be able to re-watch this live later? Yes. So typically this weekend, like Saturday or Sunday, it'll be in our YouTube channel, Chris Noggle YouTube channel. So yes. And then Amir, I'll get to your comment here in a second as well. Fake Bad Bunny says, so let's say I have a policy loan for $50K and our HELOC balance is $50K. Which gets paid first?
HELOC.
HELOC, yeah.
Your
So
HELOC is going at a straight 7-8%, whatever that may be. So the policy loan, when you borrow it, let's say we're borrowing it at 7% and we're getting a dividend of 5%. Well, that's 2% inside the loan, and you're paying 7% in the HELOC. Why would you want to put money back to cover 2% when you can cover it to pay 7%?
Mm-hmm.
And that's just in year one, because every year that interest gets better. I mean, I was in year 4, and I believe mine went down to 0.375 with the amount of monies that went to dividends to the amount of money that went to the interest. So,
yep. Good question though on that one. I'll answer this question real quick. This is from Amir. Says, talking about purpose again. Who defines our life's purpose? You do. You can have someone to guide you to find it, but it can only come from inside you. It really should not come from outside. It should come from inside. But society and mentors and all that stuff can actually influence it, by the way. But truly, it should come from you. And a lot of people need guidance on how to do that because it's not intuitive, in my opinion. And then, how do we ensure it benefits this life and the next? I mean, there's hundreds of ways you can do that. I mean, hundreds of ways. You can put your money to work. Infinite banking can create the fuel, the money for it. But once again, money is just a tool. That's all it is. So what you create with it is what matters.
And what you do with it. Philanthropy.
Yeah.
Giving.
Freedom. I mean, a big one. That's mine, by the way, is freedom of time. So yeah, love that question. All right, let's see here. All right, Jason asks, should I use $100K for my all-in-one HELOC for a paid-up addition in my policy?
What are you going to do with it afterwards? If you have $100,000 in your HELOC and you plan on putting that $100,000 in an investment or putting it into crypto or putting it into the stock market or buying a house, why would you not want to pay yourself first? By running that $100,000 through your policy, your credit union, you paid yourself first. You will be receiving dividends until you stop breathing, and you have the opportunity to make it grow in another place. So now what did you do? You took the dollar, and now you're able to use that same dollar twice.
Yep. And Jason, to elaborate on that a little bit as well, I mean, you can ask us and we'll say, yes, it makes sense. But if I look at your situation, your finances, your whatever's going on in your life, I might say, no, it doesn't make sense. It all depends upon your situation. But really, it has to make sense to you. And that's our responsibility as agents, is to help you with that and make sure that it makes sense to you before you do anything. Because until it does, don't do it. I'll be honest. Because you've got to know the math, know the numbers, and how it works. I've had some people that really want to do that, but I'll just be honest here, they have really very bad money habits, and they've invested very horribly in their life, and they've lost a lot of money. And they wanted to do this, and I told them no. Because with their money habits and what they've done with their money in the past, this would not be a good idea, because the chance of them losing it again is very high. Until they relearn how money works and have better money habits, then this could be a very dangerous situation for them. And they're like basically gambling with their money. I mean, throughout their life, that's really what it was. So you don't want to do that. Yeah.
And you can't go out and buy a Harley the next day. That's not going to make you money. It needs to be put into something to make the money grow.
Actually, Joe, that's right. Because so I had a client that had the policy. I believe they had a policy. They had a HELOC doing velocity banking. What was the first thing they went out and bought? A brand new truck with the HELOC. They had a bunch of bad debt already. They wouldn't use the HELOC as a down payment, by the way, on the truck, not the entire truck, and got a car loan. And I was just like, you just did the exact opposite thing that velocity banking is meant to do for you.
Yeah.
You created, you used good debt, which was the HELOC.
Yeah.
And then turned it into bad debt.
Yeah.
Like that's that. And then they were so frustrated as to their financial situation hadn't changed. And I'm like, but you're paying more debt now. You did the exact opposite. If you'd taken that money, paid off the bad debt, recaptured the cash flow, now you're in more control. And then the light bulb went off. But that right there, by the way, is money mindset and knowledge. They didn't have it.
No, they didn't know how to use the tool. Yeah. The bank tells us to get a HELOC so that we can put a roof on, so we can add a pool on.
Yeah.
Well, why don't we get a HELOC, put that into an opportunity, buy an investment, have that come in with cash flow, and then use that money to put the roof on, to put the pool in. Now that money's still working for you and you have your pool.
There you go. Best of both worlds. Offset bad debt with good debt. There's another way to look at it. So, all right. Let's see. Zelda says, which company do you guys use for whole life? I want to learn as much as I can. Thanks for all the work you guys do. So there's about 6 companies that can do infinite banking. We use about 3 of those companies, to be honest, because the other ones, they're different structures. They maybe don't support it as much, but it's going to be like One America Financial is a good one. Lafayette Life, which is part of Western and Southern Financial, which owns Gerber Life, very large company. And then Security Mutual of New York are the 3 main ones. And then there's some other ones that still can do infinite banking. But these ones, as we've said, I think it was on the Wealth Wednesday, it was the Emeritus comment that you answered, Stephen. These companies just support infinite banking very well. They have products that are built for it that allow us to do it correctly. We can call them up and get support, all that kind of stuff. So that's why we use those companies.
Paying dividends consecutively for over 120 years.
Yeah. Like someone asked this question right here, Guardian or New York Life? I would say neither.
So New York Life doesn't support infinite banking.
Yeah.
Guardian does support infinite banking. However, they are a direct company. Yeah. And Lafayette, One American, SML are non-direct. That means that when you take the loan, they see the loan and you don't receive 100% dividends on that loan. Unlike a non-direct, when you take a loan out, you still get 100% dividends on that money.
Yep. All right. Fake bad money. Good question here. So let's talk about convertible term. I buy cheap term insurance through my employer, but I was thinking of stopping that and instead buying my own convertible term policy that I can keep. That's not a bad strategy. So what they're referring to, by the way, for everybody else, is you can buy term insurance that is convertible to whole life, which means the death benefit from the term policy rolls over to the death benefit of a whole life policy. Now, why you would do this is it locks in your insurability from a health perspective. So let's say you get a term policy for 10 years, year 6, you can convert it to whole life without having to qualify medically. That's why you would do that. So it just locks it in. But to be honest, for convertible term, you've got to look at each company separately and understand the ins and outs of how to do that, because not every company does convertible term the same. Some you can only convert a portion, some you can't convert to PUAs, et cetera. So you just got to be aware that that is an option, but you've got to understand the limitations with each company and make sure that you understand that before doing anything. Make
sure the convertible insurance is with an insurance company that they can convert into a whole life that does IBC.
That's primary right there. Yeah, sure. Yeah. All right. So Craig, and I got your email. I think I responded back to you today already. Do you guys know there is inflation adjusted 2x the money supply available per person since '86, most controlled by a few people? Yeah, I've heard of that. I don't really understand it. I've heard it mentioned in a book I read somewhere, but being your own bank can claw some of that back. So actually, if you read the Case for IBC by Carlos Lara, he talks about how, I think it's that book, how they believe that if 10% of the population did infinite banking, it would completely disrupt the banking system. So it doesn't take that much. And that's part of what he's talking about right here. But yeah, if 10% of the money was removed from the banking system, it would have a catastrophic effect on the banking system, which in my opinion wouldn't be a bad thing. But there you go. All right. So Micah says, if I'm constantly pulling policy loans into a HELOC, then leveraging cash in HELOC for opportunities, when does IBC loan get paid back?
After you have enough of money out in investments, be it 500, be it $1 million, be it $2 million. As soon as you go from making $2,000 a month to $5,000 a month to 10 to 50 to 100,000 a month, then you can decide when you want to start filling up the HELOC and start paying back the IBC policies. But while you're in the growth phase, why would you want to just sit your money doing nothing?
Yeah, because you wouldn't pull your policy loans into the HELOC. You actually pull the HELOC into the policy to create the policy, and then policy to an asset, cash flow asset to the HELOC. And
so one thing too is I don't want you to think that a HELOC and an IBC policy are two separate things. because when you do the system, the HELOC and the policy are one. All the money comes into the HELOC. Then when it's time to run the money through the policy, we run it through the policy and then back into the HELOC, because that's where we store our wealth to grow it, to get that 50 to that 100, to lend it out or put it into the opportunity. As soon as we're making enough cash flow with that opportunity, more cash flow comes in. And then another 100 comes in. Then you lend that out. Then more cash flow comes in. As soon as that cash flow number gets high enough, 10,000, 20,000, 50,000, like I said, now you can start filling back the HELOC, because that has the higher interest rate, and then paying back the policy loan.
Yeah. And one thing to keep in mind, this is something I always explain to people, a HELOC is temporary, IBC is permanent.
Yeah.
Because the HELOC, they're typically 10-year time frames, and you got to qualify each time. Eventually, you won't qualify probably to get a HELOC again, depending on who you are. But because if your income goes down or you retire, you can't get it. You can't renew the HELOC.
If they're running opportunities, their income better go up.
Right. That's what I'm going to say. So if you want to keep a HELOC in your life, you've got to actually build your wealth.
Yeah.
Yeah. So let's keep that in mind, because a lot of people and I'll be honest, we do have a lot of clients that are not investors. That's not really their forte. They're not going to get into it. So their HELOC, if they're using it, is they expect to not to be able to renew it if they're not creating more cash flow. So just kind of keep that in mind. But but the infinite banking is permanent, which is kind of cool. So Jason said, he's going to use it for real estate lending and investing. There you go. So creating cash flow. It's awesome. Kelly says, I need guidance to begin the IBC journey to scale and expand our small hair salon business. So Kelly, so in the comments above, we put in the call link to grab a time. So you just go ahead and use that. And then Joe, if you want to put someone asked for your email address, by the way. So
Joseph at chrisnoggle.com.
Yeah, Joseph.
Can you put that in?
chrisnoggle.com.
Can you type it in? I'm on my iPad.
Yeah, let me go and grab it real quick. Let me get a question out here though while I'm doing that. Let's see here. This clause says new home, so zero equity. Can one apply the HELOC concept to securities-backed line of credit to pay down bad debt while setting up my infinite banking policy?
Well, something that you might not know is you could have purchased that house with a HELOC. You don't need a house to get a HELOC. You can actually purchase it with a HELOC. So depending on the mortgage, depending on how much you put down, depending on your credit score, there's actually a way for you to switch that after 6 months into a HELOC and be in control of it.
Yep. Let's see here. Zelda asked a question. Which company would pay the dividends if you're trying to use your bank to pay off debt and also buy real estate? Well, so the life insurance company pays dividends. And the way that we set up these policies is the dividends purchase paid up additions, which is what funds the cash value. The dividends have nothing to do with what you're using the policy for, because when you borrow from the policy, that's just cash in your hand. That's all it is. So what you do with it after that is up to you. It has nothing to do with the policy itself.
I want you to consider this as your credit union. So let's take the IBC out of it for a second. Let's say you have two bank accounts. You have Chase and you have Bank of America. When your monthly comes into Bank of America, I want you to go over to Bank of America, grab $1,000, put it over here at Chase. And then 3 days later, I want you to take that $1,000 from Chase and put it back to Bank of America. Because you did that, you ran it through Bank of America. You never took the money from Bank of America because you borrowed it from Bank of America. Therefore, that account is still making you interest. Just because you ran it through and put it back over here to Chase, you ran it through your credit union. You never take your money out. You're borrowing it from the general fund. Therefore, that bank account will keep making you dividends. Just the purpose of running it through. Now you put it into an investment. Now you're just using that same dollar twice. I hope that helped.
Yeah. Yep. All right. Fake Bunny says, where do the whole life insurance companies keep their money? That's a good question.
They
Not
invest it.
Yeah, not where you keep yours, pretty much. So they invest it. Well, they're very liquid. So they have to have 100% liquidity. So they have to have on reserves 100% of what they could pay out at any one time. So that's pretty much every death benefit they could pay out today if everybody died. They have to have that in some sort of liquid funds. So one, they're very liquid. So they're more liquid than banks by a magnitude of 10x. It's pretty crazy, is my understanding. But they also keep it in bonds. So corporate bonds, government bonds, things like that. They own a lot of hard, tangible assets, not single family, by the way, but like business offices, hotels, things like that. They own a lot of that kind of stuff. They actually do, from my understanding, they do invest a little bit in the markets. But I was told this, and I really want to verify this, that they don't lose money in the markets. They've never lost money. But they invest very differently than the average person, is my understanding. I want to see that, though, but a very small percentage of their portfolio is actually in the markets, just not very much. But that's mainly what they do invest in. So, and then, of course, you've seen stadiums that have the name of an insurance company on the stadium. They're not doing that just because they want to have their name on there. They're doing it because that's an asset to them. They do make quite a bit of money off those kind of things. So, yeah, so they have a lot of assets.
What about One America downtown where they were driving around saying, see that building? We own that building. See that building? We own that building. These high rises all the way to the sky, and that's what they own. Yeah.
And they're very good. So keep in mind, so insurance companies are very regulated on what they put their money into. They cannot be very risky with their money because it's a regulated industry. Additionally, when they have to pay out a death benefit, so they have to be very good at how they invest their money because they have a guaranteed death benefit they got to pay out down the road. So they invest long-term, very
long-term growth, stable long-term growth.
They think in the terms of a human lifespan. That's hard.
You still there?
Yeah, I'm still here.
Oh, you froze. Okay.
Indigestion. Sorry. Yeah. Let's see here. Let's see. Responsibility matters. That's another purpose question. So, if you want to talk about that, you can always reach out to me. So Zelda says, how can we schedule a one-on-one for more questions, or one-on-one? I think you mean. So I'll put the link in the chat box here in just a second again to schedule a call with one of our mentors.
Am I on that link?
Should be.
I'm not.
Or if you want to reach out to either Joe or I personally, just let me know and we can do that. So there it is right there. So I'm trying to copy, but it won't let me copy it. So let me go and put that link in the chat box again, and then we will call it a day. If any last minute questions, feel free to go ahead and put those in the chat box. .com.
Did you put my email in there?
I did. Yeah.
Cool. Thanks.
Book a call AMA. All right. Any other questions we got so far coming in here? There we go. So Terry's asking, is the money movement different if you are starting with a second position HELOC is what they're referring to?
A little. I've done it both ways. I've been utilizing HELOC since 2013. I've paid off my house 10 times. So it's a little bit differently. The money still is going to come into the HELOC, except now you just have the bigger bill of the mortgage, but you're still performing velocity on that second lien. I still don't want the money in a checking account. So yeah, you would still move it to the HELOC until the time is ready to be moved, because at least your money is still working for you. So a little bit different, but not that different.
Yep. And then this is a good one too, right here. What is considered an average break-even year for infinite banking? And so what they're referring to, by the way, when they say break-even, it's when do you have more cash value than you've funded the policy with. So I have $100,000 of cash value. I put $100,000 into the policy. That's called break-even.
I'm breaking even between year 5 and year 8.
Yep. And there's a lot of factors, Rachel, that will impact that. So age, gender, the insurance company that you go with, size of premium, if you do a dump-in, all of those things will move that number. I've had it be as the earliest is year 4.
Yep.
I did year 4 one time. That was really amazing when I did that, but that's very rare. But I've had also year 12 or year 13. So it just depends on a lot of factors and what you're trying to accomplish with it. If you're a juvenile, by the way, it's going to be year 15 or something like that, or something down the road. If you're 30 years old doing this, it could be year like 6, year 5. Just depends.
It depends on the efficiency and, like Brian said, the amount of dump-in and overfunding and everything goes as a piece to the puzzle.
Yeah. All right. Well, I think we got all the questions. Okay, here's one from Dex. What LTV do I need to be to use first lien for purchase? Loan to value is what that LTV.
If you're running on your personal 720 credit score, 89%, we can go up to the house for the LTV. Qualifying for at 45% of your DTI, that would be the income. Your income coming in at a DTI of 45% of your income, 89% up to of the house. And if we're consolidating and doing all of that, it's going to go off of the maximum line of credit if there's no other debt outside of that.
Yep. All right.
That.
So Joe says, can I still get help from you if Hannah is my mentor?
Absolutely.
Yeah. So I just put in Joe's email and my email in there. So yeah, go ahead and reach out to him there. And this, I think this will be the last question here. 808 for life. So I just found out I have a life insurance policy from my employer, which has cash value. So it's probably, I'm going to guess, it's either going to be whole life or a VUL. Almost always, it seems like the two types that they have. But it has cash value, but it's not adjustable the way infinite banking is. Yeah, it's not going to be an infinite banking policy. It's most likely going to be with a stock insurance company, probably not a mutual company. They still pay dividends in some situations, but it's not going to be the same way. And then the last part is, would it still be worth overpaying to build cash value? You might not be able to overfund it. You might not be able to if it's not built for that to occur. So like if you have some policies that are that kind, the death benefit never changes. The cash value can go up, but the death benefit doesn't because of how they're structured. And so you can only put in a certain amount of cash value before you have to stop, and it's not going to be very much. And I've also seen those policies like this one that they don't ever break even. They never break even. But bottom line is you just have to look at the structure of the policy. And we can help you with that, by the way, to analyze it. But in most cases, it's usually not worth overpaying that one because if it's an employer policy, when you leave the employment, the question is, what happens to that policy?
Yeah.
It should stay with you. If it has cash value, it should stay with you. But the premium, that's what you want to understand. Is the premium going to change? Is it going to go up? You're going to be paying that out of pocket. Was the employer paying for it? There's probably another dozen questions I could probably ask about that one. So
that was a big question. If it's the employer, who's the owner of the policy?
Yeah. Usually you can take it with you. You can take it with you when you go. It's just the premiums might change, or you might also be paying out of pocket. But you got to understand that how that policy functions today and 10, 20, 30 years down the road. You got to understand, because if it's a certain other type of policy that I'm referring to, it won't look that good down the road. And believe me, I have personal experience with those policies. They are horrible.
All right.
Here we go. It's labeled as Fleximum Premium Life. So flexible premium life is probably a VUL.
That's what I was guessing, but I didn't want to think.
Yeah, it is. I just looked it up really quick. I've had those before, so I get it. Yeah, so it's a universal life, which is flexible, but most ULs or VULs, unless you start putting more money into those things down the road, it'll eventually go to zero. Yeah, but I can show you my illustration. I actually have it all sitting right all over because I want to remind myself of the first policy I ever got and how bad it was.
Did you put spawn of Satan on the top of it?
Yeah. The person that sold it to me, that's the spawn of Satan. That guy lost me over $500,000. So not through the policy, but other ways. So yeah, and a lot through the policy too. Basic life policy is paid by the employer. Yeah. So if it's paid by the employer, then when you leave, then you're going to have to take it over. Yeah. So there you go. All right. Well, guys, I know we went over about 8 minutes. So what's that?
Time to wrap it up.
Yep. All right. Appreciate all the questions, everybody. And with that, another Ask Me Anything in the books. We will see you next week. And if you need anything, just go ahead and grab our emails or the call link in there and reach out. But see you all later.
Talk to you soon.